gold prices are breaking new record highs again. While this is good news for gold investors, there's also a hidden warning sign here that most people are overlooking. Take a look at this. The stock market is the blue line and gold prices are in orange, and you can see in 2025 gold prices are outperforming stocks. Let me show you why this is so important. In the last 100 years, we've only seen gold prices outpace the United States stock market 5 times. When? Well, let's go down the list. Number 1 was during the Great Depression during the 1930s. Number 2 was during the 1970s when President Richard Nixon took the United States dollar off of the gold standard, which created an inflation problem, stagflation, and a lot of concerns about the United States dollar. Number 3 was back around the year 2000 when the dot-com bubble burst and we saw a big recession because of that. Number 4 was around the 2008 time during the great financial crisis when the housing market crashed and people thought that the financial system was going to collapse. And then number 5 was, well, this period, post-pandemic between 2020 and now in 2025, when there's concerns about the United States dollar. History doesn't exactly repeat itself, but it does rhyme. And what we've seen throughout history is that when gold prices are outpacing the stock market, generally investors are worried about something. And this might have you wondering, what is it that investors are worried about now in 2025? Well, what most investors will tell you is a concept called the debasement of currency, meaning the value of our dollars dropping, which could lead to a debt crisis, which is why in this video, I want you to really understand what's going on in the economy, debt, and gold. Now, to really understand what's going on, let me start by laying the base foundation, which is the United States government is not a for-profit entity. It generates revenue by taxing taxpayers. So you go to work and you pay taxes to the United States government, and it's expected in 2025 that the United States government is going to collect around $5 trillion in taxes. Now, this is where the government collects this money and then they're gonna go out and spend this money. They're gonna spend this money on things like healthcare and the defense and infrastructure and technology. And so the government goes out and spends this money, and you might think that if they generate $5 trillion, that they might spend a fraction of that, maybe $4 trillion. That way they can save and invest a piece of it, but that's not what happens. In fact, the United States government doesn't just spend $4 trillion. They don't spend $5 trillion out of the $5 trillion that they generate. It is expected that in 2025, the government is going to spend around $7 trillion, which means there's an additional $2 trillion that they spent that they did not generate from taxes. That $2 trillion is called deficit spending, and the deficit spending has to be financed through debt. Now, you might be wondering, well, who is lending money to the United States government to finance the $2 trillion of deficit spending? And it's a few different entities. Number 1, it's regular people like you and me that can lend money to the United States government in exchange for interest payments. Number 2 are institutions like big banks or corporations that have a lot of dollars. They can lend/save their money by lending it to the United States government in exchange for interest. Number 3 are foreign countries like the United Kingdom, Japan, China are some of the leading lenders to the United States government, so they can lend money to the United States government to save their money and also generate some interest. And the number 4 is our central bank, the Federal Reserve Bank. And the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not federal because, well, it says so on the website, and they're not part of the federal government. But the unique power that the Federal Reserve Bank has as the central bank is they have the ability to create money out of thin air. They can print this money and then lend it to the United States government. And if you remember what I said a couple minutes ago, in 1971, the United States dollar was taken off of the gold standard, which allowed the Federal Reserve Bank to print essentially an unlimited amount of money, because prior to 1971, if the Fed wanted to print more money, it needed more collateral, more wealth, and that collateral used to be physical gold. Now that our dollars are not backed by physical gold, the Federal Reserve Bank can print essentially an unlimited amount of money and lend it to the United States government. That way the government can then go out and spend this money and inject it into the economy, and it can pay people's salaries, they can pay businesses contracts, and they can continue funding and growing the economy that way. But there is a consequence, and the consequence is none other than inflation. Now, a lot of people think that inflation is the prices of things going up, which is a byproduct of inflation, when in reality, inflation comes from the word inflate, because what's happening is you were inflating the monetary supply. You're increasing how many dollars are out there, causing the value of each dollar to go down, which then, as a result, causes the prices of things to go up. So your rent gets more expensive, your groceries get more expensive, cars get more expensive, vacations get more expensive, and what we've seen throughout history is that while the prices of things go up, generally, the average wage, average incomes don't keep up with inflation, which is why the average person struggles more to buy a house, to buy a car, to pay for college today than they did 50 years ago. Now, I know what you're thinking, but what does all this have to do with the price of gold? Well, people generally look at gold as a hedge against inflation. But the problem with gold is it's not actually producing any real value, because when you buy a stock, like say invest your money in Amazon, Amazon is working to produce bigger profits. They're working to produce a product. They're working to produce value, versus your gold is just sitting there in a vault looking back at you. It's not producing any value. So when you see the prices of gold rising faster than stocks, that creates concerns, because that means people are more concerned about losing the value of their money than they are about growing their value by investing into these assets. And this is where there are three other things that I want you to pay attention to that are happening as we speak, starting with number one, gold revaluation. Now, I do want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll also show you the exact framework that my firm and I use to research investments and find opportunities before they hit the headlines, because we like to invest based off of research and data instead of just hype. And as a bonus, for when you register for this free masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, all for free. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. So let's talk about gold revaluation, because in August 2025, the Federal Reserve Bank posted an article on their website talking about revaluing our gold reserves. Now, if you have no idea what that means, don't worry, let me explain. The article says that the Fed is, quote, considering revaluing the government's 261.5 million troy ounces in gold. So according to the Fed, the United States government is sitting on 261.5 million ounces of gold. But what is it valued at? According to the Fed, it's valued at $42.22 per troy ounce. So if we do some basic math, take 261 million ounces of gold, multiply it by $42.22, which is what the government has been valuing its gold reserves at. That means the United States on its balance sheet has $11 billion worth of gold. And this is where the Federal Reserve Bank says, maybe we can help solve this debt problem by revaluing the value of all of our gold that we have, especially because gold prices keep breaking brand new record highs. According to this article by the Fed, they suggested revaluing it at $3,300 per ounce. That means if we're sitting on 261 million ounces of gold, instead of valuing it at $42 an ounce, let's value it at $3,300 an ounce. And now the United States government is not sitting on $11 billion worth of gold. It is now sitting on around $860 billion worth of gold. We're talking about an additional $850 billion worth of value by doing nothing except changing some numbers on our financial statements. And then what the government could do is they take this certificate to the Federal Reserve Bank and says, hey, Fed, we have $850 billion of this asset. How about we convert this to cash? And that's where the Fed can then convert that gold certificate to $850 billion. And now the government has money to spend while keeping these gold reserves in the vault. Now the United States government has an additional $850 billion that they can use to either pay down their debt, or they can use the $850 billion to inject it into the economy, create more business contracts, hire more employees, and stimulate the economy in that way. Now, I don't think anybody would be upset if they woke up one day and found an additional $850 billion in their bank account, but there's a couple problems and risks associated with this. Risk number one is, what happens if gold prices go down? Take a look. As you can see on this chart, gold prices fluctuate a lot. Between 2008 and 2012, gold prices skyrocketed when people were worried about inflation and the economy crashing. But then in 2012, when those fears started to go away, gold prices crashed as the economy recovered, and gold prices did not hit new record highs until 2020. almost 10 years later when the same worries about the economy and inflation started again with the pandemic. This is why some people call gold the debasement trade, because when people are concerned about inflation and the dollar, they turn to gold. But if people are not worried about inflation and the dollar and the economy, then they dump gold and then they want to buy other investments. So gold prices go up and they go down. And if the United States government does this gold revaluation and then concerns about the dollar and the economy go away, gold prices could crash. And if gold prices crash and the United States government has spent this money, well, that would mean that the Federal Reserve Bank now has a loss on its balance sheet. And that's not so good for other people like foreign governments thinking about investing their money into the United States, which means that could mean that the United States government will be forced to pay higher interest payments to incentivize people and make people feel comfortable to lend money into the United States. So yes, there are serious risks if the United States government does gold revaluation and then gold prices fall. Point number 2 that you want to pay attention to is a concept called de-dollarization. There are certain countries around the world, notably the BRICS countries, that's Brazil, Russia, India, China, and South Africa, that are trying to move away from the United States dollar and building a pact to try to strengthen their own currencies. And the reason why it is so interesting, because many of these countries have talked about, number 1, potentially creating their own currency. That way they can no longer have to trade by the United States dollar. And then there's been talks to strengthen their currency by having it backed by physical gold so it can compete against the United States dollar. Now, there's 2 reasons why this matters and why you want to pay attention to this. Reason number 1 is because the value of the United States dollar is what somebody else perceives it to have, because the United States dollar is what's known as fiat currency, because it's not backed by a precious metal like physical gold. It's backed by a promise that the United States dollar has value. And because the world trusts the United States dollar, because it is the world's reserve currency, that means that people have to have faith in the United States dollar. Why? Because as the world's reserve currency, a lot of the world's trade happens in the United States dollar. So even countries that are not trading with the United States oftentimes have to trade based off of the United States dollar. That gives value to the United States dollar. But if people start to lose that trust in the United States dollar, well, that could hurt the value of the United States dollar, because, well, a lot of reasons why the United States government is able to print and spend money at the way that they do is because people have trust in the dollar, and that allows the government to print and spend more money that other countries can't. The other reason why you want to pay attention to this, number 2, has to do with supply and demand. Because as these other countries are trying to strengthen their currencies, central banks around the world have been buying up gold at some of the fastest rates we have seen in many decades. So as these foreign countries and central banks have been buying up more gold, well, that means there's more buyers for gold. Think about supply and demand. There's not an infinite amount of gold in the world. And to increase the amount of supply, more gold has to be mined. That takes physical time, effort, and labor. Versus the demand for gold has been rising much faster, because now not only are people and investors buying gold, but now with central banks spending all this money to buy more gold, that has been fueling more demand for gold. When you have more demand than supply, more buyers than sellers, in this case, central banks also buying the gold, that pushes the price of gold up because there's more buyers out there, increasing the demand, which has been helping the price of gold rise to new record highs. And last but definitely not least is point number 3, which is deficit spending. Remember, the United States government does not have a balanced financial statement. They generate tax dollars and then they go out and spend more money through the help of debt. But what we've seen happen, especially post the year 2020, is that the amount of money that the United States government has been spending has increased drastically, and we haven't gone back to pre-pandemic quote-unquote normals. Let me show you what I mean. In 2025, it is expected that the United States government will have around $2 trillion worth of deficit spending. That means, again, that the United States government is going to spend $2 trillion that they don't have from taxes, which has to be financed through people like the Federal Reserve Bank. In 2024, it was about $1.8 trillion of deficit spending. In 2023, it was about $1.7 trillion of deficit spending. In 2022, about $1.4 trillion. In 2021, about $2.8 trillion. Again, that's when we were coming out of the pandemic and all the stimulus that the government was doing. In 2020, we had $3.1 trillion of deficit spending, the most amount of deficit spending in the history of time. And then in the year 2019, we had around $984 billion in deficit spending, which means in 2025, it is estimated that the United States government is going to more than double the deficit spending we had back in 2019. Why? Did we get used to a whole lot of government spending during this pandemic era and then we never went away from it? Because it looks like the pandemic era deficit spending really cooled off in 2022, but we didn't go anywhere near back to where we were back in 2019, and we've been accelerating government deficit spending since then. Could that be a problem? And this is where I want you to understand the consequence of this, because what a lot of people say is, well, why doesn't the government just stop this deficit spending? Well, there is a cost to that. Let me show you what I mean. Our economy is measured through a number called GDP. GDP is a measure of all spending that happens in the economy. So when you go to Chipotle and you buy the bowl, that's contributing to the GDP. When you go to Chipotle and you buy the extra guac, you are contributing even more to the GDP. And when you go to Chipotle, you buy the bowl, you buy the extra guac, and you don't have the money to pay for it, and you finance it on your Amex, you are contributing even more to your GDP, because now you're making Chipotle richer and you're making Amex richer. But the largest spender in our economy is not you, me, Amazon, Tesla, or Nvidia. It is the United States government. And so in 2025, our GDP is expected to be around $30 trillion. Again, this is just an estimation because we haven't finished 2025 yet. But again, the largest spender here is the United States government. Remember, the government is going to spend around $7 trillion in the year 2025, which is a big contributor to the GDP. And $2 trillion of that $7 trillion that the government is going to spend is deficit spending, which means the deficit is about $2 trillion of the $30 trillion, which means if the United States government were to hypothetically stop overspending and overpaying for things that they don't have money for, that would mean that our GDP would fall, in theory, to $28 trillion, because you just take out the $2 trillion of deficit spending, which means our GDP is now $28 trillion, which would mean that our economy would essentially shrink by 6%. Why does that matter? Well, let's put this in perspective. In the year 2008, which was the biggest recession that we have seen since the Great Depression, we're not talking about the pandemic. During this Great Recession that we saw in 2008, the United States economy fell by slightly more than 4%, which means if we were to cut back all this government spending, we would see a recession 50% bigger than 2008. That's the problem. When you become addicted to that sort of government spending, removing it becomes extremely painful, because that means the government has to stop spending money, which means people lose their jobs. Businesses lose contracts, the economy slows down, and we go into a recession, and that's painful. But so is the alternative. Because if the United States government keeps spending money that they don't have, well, that means money has to keep being printed. And as you keep printing more and more money, the value of the dollar goes down, causing the prices of things to go up, which is good for investors, especially who are strategic, but it's not good for the average person, because the average person's salary doesn't keep up. The average person becomes poorer, your savings don't have as much buying power, and that's where you start to see a bigger divide between the rich and the poor as the middle class shrinks and shrinks and shrinks. And that's the concern that we're seeing happen right now, and what we're seeing happen today, especially with the price of gold, is people are getting concerned about the dollar. That's why they're seeing more investment go into physical gold, and that's where the concern is. If gold prices are outpacing things like the stock market, could there be bigger concerns ahead? Because while history doesn't exactly repeat itself, again, it does rhyme. And the only other times we've seen gold outpace the stock market was during a major downturn, during something like 2008 or 2000 or the 1970s stagflation era or the Great Depression. So I don't say this so you panic. I say this so you are a more financially savvy investor and understand what's happening. Yes, there's a place for gold in your portfolio, but understand why people invest in gold. Today, we have people that are buying gold hoping that they're going to get rich, when in reality, gold has traditionally been a hedge. It is a protectionary investment as opposed to a growth investment. But I want you to understand the different ways that you can allocate your money, because if you are going to be investing your money, understand what the options are and understand the risks that are out there. That way, again, you can be a savvy investor. And I don't want to tell you what to do, because personal finance is personal. You have to understand how you can take this information and play it into your portfolio. That way you can build a balanced portfolio. That way you can win when markets are going up, you can win when markets are going down, and you can win when markets are going sideways, because we know that recessions happen. They've happened every decade for the last century, and they're going to continue to happen. And the financially savvy that understand this will be able to build more wealth when the next downturn happens. Not if it happens, but when it happens. We know it's going to happen, we just don't know when. And when you understand that, now you can start to use this information to build your wealth even faster by understanding, number one, what are the assets that you want to invest in? How do you research those assets? And then number three, how do you have the capital to actually make those investments when good opportunities arise. Again, if you want some more resources, I have my free investing masterclass for you down in the description, but this is where it pays for you to be a financially savvy investor. Literally, but I want you to understand that yes, there's great opportunity when gold prices are rising, but I also want you to look a little bit deeper and understand how this could create concerns as well. So that being said, if you got value out of this video, I would really appreciate it if you could help spread the word about what's happening. The best thank you is a referral. So please, if you could, share this video with a friend, family member, colleague, or fellow investor. That way we can continue spreading the financial education. Thank you. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.